Hi everyone and welcome to Investing in Canada. The objective of this course is to help you make your investments in the most efficient way. So let's start with the exciting topic that we are going to discuss today. So if you are new, please subscribe and activate the notifications so that you are updated each time we upload our video. Our channel is EduFin Wizards on YouTube. You can get the complete access to this course on Udemy or Skillshare. The links are in the description. So we are dealing with the exciting topic of real estate. We have already discussed what are the ways of investing in real estate and what are the benefits of investing in real estate in the previous videos. So you haven't checked them yet, please go ahead and do that. In this recording, we are going to discuss things that impact the real estate prices. So the first major thing that impacts the real estate price in Canada is the supply side, that is the supply of new housing. So there is something called as housing starts. So what is housing start? Housing start is number of new construction that is started in Canada every year. Now, Canada has the lowest number of housing units per 1,000 resident of any G7 country. So the housing that we construct and the housing that we have is not enough for our people. So housing starts have a negative relation with prices. So if the housing starts remain low, then there are not enough housing in the market. So that increases the price of already existing houses. So housing starts are very low as compared to what we need. Canada needs around 5.8 million new houses by 2013 to tackle affordability crisis. So that comes to roughly around 500,000 plus housing needs to be constructed every year, right? So that we can tackle the affordability crisis. But we are not there. So if you see, we are somewhere around 270 to 300,000 new housing being constructed in Canada every year. That is not enough for sustaining the demand that we have. So this is leading to upward pressure on housing prices, especially in markets like Vancouver and GTA where it's hard to construct. Okay. And this problem might not solve itself in the near future. So there is always going to be a supply side pressure because we are not constructing enough houses that we are required to do. Then Canada immigration rate also has an impact on real estate prices. So we do not have a natural population growth in Canada. The birthing rate is not enough to replace our population. So we try to replace it by getting immigrants. So the immigration rate has a positive relationship to real estate prices, especially the rental market. So if people are coming in, they need a place to rent. So the rental market will have an upward pressure if the number of people coming into our country increases. So immigration is positive for real estate markets. If you see, Canada accepts around 300,000 immigrants every year, right? Since COVID-19 started, since the pandemic started, we are not close to that. So the number of immigrants has been going down. So if the number of immigrants coming into this country again picks up in 2022 or 2023, then we can again see an upward pressure on the real estate market. The biggest impact that any factor has on real estate prices, the biggest impact is for interest rates. So interest rates have the largest factor impacting real estate prices. There is a negative relationship between real estate prices and interest rates. So if interest rates go up, the real estate market goes down. Okay. Why? Because higher the interest rate, lower is the mortgage affordability. So if the interest rates keep on going up, the mortgage affordability that we have in our country keeps on going down. I've given you an example. So if suppose you have an $100,000 income, $50,000 for down payment, and the mortgage interest rate is 2%, then you may able to afford a house that is somewhere around 400 to 420. Okay, that is your affordability. This is based on CMHC calculator. Okay. Now, if the interest rate goes to 3%, your affordability goes down to 366. So your affordability from 400 goes down to 366 if the interest rate goes up by 1%. If it further goes up by 2% to 5%, that is what is expected to, that we might have a mortgage rate of 5% plus in the near future, then your affordability may be down to 300,000. So we had an interest rate situation where interest rates were quite low for decades now. right? But inflation is high right now. So to tackle that inflation, the Central Bank of Canada, Bank of Canada, is increasing the reference rate, the interest rate that is there in the market, which because of that, the prime rate that the banks have on mortgages, that is also going up. So interest rates have been going up for last 1.5 years, and they're expected to go up further into the future until we tame this inflation. So it is expected that the affordability that people have in terms of mortgage might go down even further. Okay, high interest rates are not good for real estate prices. Inflation is also something that impacts impacts real estate prices. High inflation is negative for housing. Inflation means how much you spend on groceries, how much you spend on gas, how much you spend on daily necessities. If that amount goes up, you do not have disposable income that you might want to spend on housing, right? So if affordability goes down because of high inflation, it impacts real estate because people might not buy properties or buy second homes if they cannot afford to live. So high inflation decreases the disposable income that leads to lower mortgage payments and thereby affordability of mortgages. So you can see the inflation has been quite low for like many years, sub 2%, 2 to 3% inflation, but inflation has been kicking up. So it is almost a 40-year high inflation that we have right now. So inflation used to be 2 to 3%, but inflation right now is 8%. So if we sustain this high inflation, then the affordability that people have goes down. So that impacts the real estate prices. So let's see what is the current situation. Let's combine these factors. So in the market right now, there is high inflation and high interest rates. So we have very high inflation and the interest rates are also going up to tame this inflation. This is leading to real estate price correction. So prices of real estate are going down. There is a 25% plus correction in most of the markets, right, since the peak that we had in February, March, okay, of 2022. So real estate prices are going down because of high inflation and high interest rates. But the rental market is reverse of that. Rents generally go up if the interest rates go up, because people who have mortgages, they pay more, so they jack up the interest rates. Okay, so though these factors are leading to rental income going up, so real estate prices are going down, but the rents in the country are going up. So there is a renter crisis in the country right now. For example, Calgary's average rent has shot up by more than 21% year over year. That is very high. In a single year, rents have gone up by more than 21%. So if you are into the rental market, if you have already bought a place, right, before all this craziness of price increase happened and the bubble was formed, then you're enjoying the higher rents that you're getting from the renters. So it is extremely important to, if you are especially an investor in real estate, to time the real estate market. Okay, like it's very crucial, especially in places like Calgary that go through this boom and bust cycle because of the oil prices also. Okay, specifically in Calgary and Alberta, real estate is also linked to oil prices. If oil prices are high, our province has a lot of money, people have a lot of jobs, so real estate generally tends to go up. If the prices are low, like if the oil price goes down, then the price drops too. So you can actually try to time the market. So in the next class, we'll discuss what is buyer's market, what is seller's market, right? What to do in a buyer's market, what to do in a seller's market. So that is something for a future video. Also, this is a common theme that has been going on for quite some time. We do not construct enough houses in Canada. We have like bureaucracy that stops from new construction. We have a labor shortage right now. The skilled labor that is required to construct houses is in short supply. So the housing construction costs are very high and the housing starts are also not enough. And they are not expected to be corrected in the near future because of like a lot of factors that are beyond our discussion today. But you have to remember that supply side, there is always going to be a pressure, right? Because we do not have enough housing. So Please subscribe and activate the notifications if you like videos like this so that you're updated each time we upload a video. You can get the access to complete course on Udemy or Skillshare. The links are in the description. Thank you very much for your time and see you in the next video.